This particular webinar is geared a little bit more towards maybe like mid-market businesses.
Yep.
Or a lot of what we do a lot of the times is geared towards a small business, but we've seen a trend in the business in the past probably, what would you say, Greg, 2 to 3 years now?
About 3 years now.
About 3 years we've seen larger businesses doing, north of, $100 million a year in revenue that are now starting to take advantage of alternative lending options. I think in the past, when this product really kind of first came about, a little bit of a stigma around it to where maybe, one, just not a lot of education around it, knowing exactly, what's available or how the product is structured. There's also been a lot of changes in how the product operates today. When the product first came about, it was really just a daily payment where businesses would get an ACH from their business checking account, once a day, Monday through Friday, like little micro payments, which is obviously not typical for financing or how lending typically works. So that might have been something that would, keep a larger business, a mid-market business from entertaining this type of capital. But the advancements in the product today, this is there's weekly payments, there's bi-weekly payments, there's bi-monthly payments, there's monthly payments. So a lot more traditional style, repayment options. Also a ton of flexibility, and I think that was probably the most attractive thing to mid-market businesses when we really started to see them, kind of come downstream and start to take this type of funding. Was probably the flexibility.
Correct. There's a lot of customizing and some real flexibility payments as well, right? So we talked about daily payments and weekly payments, getting that up to bi-weekly, monthly. There's even payments that flow with the revenue cycles, right? So there's been some staggered payments where it could really fit to how that business operates their cash flow and follows suit.
Yeah. Yep. So it's a great point, and I kind of felt like you were going there with that, with the flexibility. These alternative lenders, they're not held to the same covenants as like a traditional bank would be on how they put the funding together. So if one of our lending partners is speaking to a business and understands that the business is seasonal, or understands the use of funds and how they're going to be using the capital, not only can nowadays they get that monthly payment like we talk about, but they could also get reduced payments, maybe a percentage of what their typical payment would be in the first few months while they're using the capital.
Correct.
Waiting for the use of funds to materialize to where maybe they invested it in something, now they're seeing a return, and maybe 6 months into the loan, now the regular payment starts to kick in. Sometimes they'll structure maybe a balloon payment at the end.
Correct.
And then by the time that you refi that, they kind of just roll the balloon payment into the next funding. So, and even flexibility with like other type of products, like a lot of mid-market or larger businesses that already have like a senior facility out, right? They already have a line with their bank, or they are factoring in their business. A lot of times, you're not able to get additional financing or funding options because of those senior facilities or factoring lines that might be in place. But in the alternative lending space, when you're working with the right partner and you're having open communication with the lending partner and you're explaining the situation and they understand the whole landscape of what's going on in the business, there are actually ways where they could structure it, where they could provide funding, as a junior facility. They could provide gap funding. They could provide an additional line alongside of a factoring company. There's usually like an intercreditor agreement.
Correct.
That we could execute where they'll actually work with your factoring company, and put you in a position where you are able to get additional capital in the business to take care of whatever it might be that's coming up at that time. So.
Correct. And just to add to that, right, it's also used as a bridge. A lot of these alternative style financing products, not only for whatever opportunity they have to supplement their senior credit facility, but sometimes these, I've been seeing the last probably year, these mid-market companies outgrowing their bank in their first position.
Yep.
And they're looking to get something to replace and go higher than what their first position lender is offering them.
Gotcha.
Sometimes a bridge is needed to bridge out of that and get into a larger facility.
Yeah, no, absolutely. Makes a ton of sense. And honestly, thank God alternative capital is a thing, and it's available, and should be taken advantage of. And I think that's kind of the point of doing this this session here today, is just to bring more awareness around alternative lending and the flexibility that comes with it. And the potential, right? Not everybody really understands, like, they might think of alternative lending or cash advances or term loans, and that's just short-term, low, low dollar amounts, right? Maybe 100K, 150K. But the truth of the matter is we're doing seven-figure deals. We're getting $2 million deals done, $5 million deals done. We're working right now on an $8.5 million transaction. So that's something that I don't think is mainstream information. I think a lot of times, when I'm hearing conversations with these, mid-market businesses, those that, typically in the past wouldn't entertain this type of capital, they're just under the impression it caps out at 250, 500,000, and
Most of the time, yeah.
And quite frankly, that's like an average deal these days. Before we dig any deeper, me and Greg here, kind of just jumped right into it because, we're passionate about this stuff. We have both been doing it for well over a decade now, and have helped grow sales teams and companies, and are known within our industry and speaking at events and on panels. And so if you throw a microphone in front of us, we're just going to jump right into the conversation. But we should definitely take a moment to introduce ourselves and before we dig any deeper here and go into it. So to my left here is Greg Amendola. Greg is our Senior Vice President of Sales, Finance. Greg really runs our entire operation when it comes to helping small business owners obtain capital, maintaining relationships with our lending partners, finding new lending partners, navigating new products, educating our consultants on our staff so that they're best equipped to help small businesses. So Greg is a key part to the success here at the company, and by far the most knowledgeable guy when it comes to the lenders and the products and what we have available, which ultimately results to how we can help the small businesses.
Thank you for the intro.
No, of course, well deserved. My name is Patrick Manning. I'm the CEO here at ROK Financial. Spend my time working alongside the leadership team, those that run each department here at ROK, to just provide support and direction to ensure that we're constantly keeping our foot on the gas as a business and always looking for new ways to streamline processes and reach small business owners and have the best products and options possible that we could offer and stay as competitive as we can be. Ultimately, running small business is an extremely difficult task. Hats off to all small business owners. What we have learned over the past 10 or 15 years being in this business is that many small businesses have sacrificed it all to get their business off the ground.
That they have, and more.
Yeah, and some. And we feel fiduciary responsibility to be there for small business owners and identify new products and programs that are available to help them ultimately capitalize on and take advantage of, so we can make their lives as easy as possible when it comes to running the business and capitalizing on opportunity, but not just opportunity, right? We see a lot of times that these small businesses are borrowing for both opportunities and challenges. Right. There are things that come up in small business that are not planned and you didn't see coming, and sometimes you just need access to something quickly to help you get over the hurdle. So whether it be for an opportunity or a challenge, ROK Financial, it's our goal to be there for the small businesses and now mid-market businesses and help provide and educate on whatever we possibly can. So we'll dig in here a little bit. So kind of on the piggyback of what I was just speaking of is why businesses leverage capital could be for an opportunity or a challenge. But some different bullet points here: increase operational capacity, invest in marketing and sales, hiring employees, purchasing inventory or equipment, improving cash flow flexibility, and obviously, taking advantage of time-sensitive opportunities. So this particular slide, is really more focused on the opportunity side of things, right, and not so much the challenges. What are some challenges, Greg? Seeing that they're not on the screen, what are some challenges that are popping up in business that you've come across recently to why they're looking to leverage some type of funding?
So it's a common one, and it's not talked about enough, in my opinion. Business moves quick, right? And if you're just consistently stuck in bank financing or your senior position lending or traditional financing, you may not have the luxury of time to take advantage of that opportunity. And then in turn, that poses a big challenge. You're trying to grow your business, and you can't secure the funding in time to take advantage of that opportunity. Some other challenges could be, buying out a partner. We see that time and time again. You may not want to use the personal capital or personal funding to purchase the rest of the business or buy out a partner. So there are other avenues and products and programs to do that through.
Yeah, absolutely. There could be a lot of things that pop up in business. The IRS is always all of our best friend,
Uncle
right?
Sam is knocking at the door.
Yeah, so that comes up from time to time where you're hit with something that you weren't really expecting, and obviously want to keep operations running smoothly and need to get that out of the way in order to keep that in place. So there could be things like that, related to just financial responsibility that kind of comes up unforeseen that needs to be handled.
Slow paying customers too.
Yeah.
A lot of times AR can get backed up, and through no fault of your own, your customers might be waiting on payments that's out of their control.
Yep.
So
Yep.
it all funnels back to the business owner, and slow paying AR, it's out of your control. So there are those other avenues that you can take advantage of.
Yeah, no, absolutely. Other challenges, that could potentially pop up. I mean, sometimes in depending on the industry that you're in, there could be regulation, right? Regulation changes, or needing of certain licensing, or just the way that you could be operating business today as you always typically have, and something changes in the business, and now you're required to go about something in a way that you hadn't had to gone about it in the past. What type of financial strain could come up in that sense, right? Maybe needing a new license, or just having to change the way that you go about something, and maybe cost has increased, right? We've seen recently with like tariffs have become like a huge thing, and it's really changed people's margins and how they're earning on certain products, or whatever the case may be. Maybe they're changing suppliers, or
Supply chain delays as well.
yeah, so there's just an array of things, right? So it's not always. I think we kind of hit on the point of it. It's not always about having an opportunity in the business, but sometimes it's solving a problem as well. And both require a need of capital. And I think understanding as you're running a business, whether you own it, you're the CFO. If you're involved in the financials of a business and keeping a business afloat and growing, I think it's just useful information to know all of the different options and routes that are out there. And that's, again, just to bring it back to kind of what the whole purpose of this is in the first place. It's just to bring awareness, awareness of an industry that started roughly 20 years ago, solely on the backs of private lenders, hedge funds. And today is a $400+ billion industry. Companies like PayPal, Shopify, Square, that are now some of the biggest lenders in our industry. So a lot of mainstream, big time companies have identified and have seen the need for capital with small and medium sized businesses, and have gotten involved as well. So just never a bad idea to continue to spread the awareness. So kind of moving on here, capital should support momentum and not create operational strain. And that's, that's, again, just going into exactly why we're having the conversation and making it known on kind of what's out there. With that, preserving equity while fueling growth. This is always something that's very interesting, and I think definitely pertains to the mid-market businesses. Is many times when you need a capital injection in the business, I think it's always kind of a first thought to maybe distribute some equity in the business. We're always big fans of kind of arguing against that, right?
Absolutely.
That could be a lot more expensive in the end.
I was just going to say, preserving your equity, it's giving some of that equity up. What are you losing long term, big picture, right? How much is that equity really going to cost you over 5 years, 10 years, 15 years, and the next generation if you're passing that business down?
And I don't think that these businesses just particularly choose to, shed equity in their company, in exchange for capital. I think it comes from a lack of awareness. I think it comes from not understanding that there are other options out there to get that capital. When you really sit down and do the math on, hey, if I take some bridge funding or some hard money, and I mean, let's even be aggressive, right? And say that capital is going to cost me, 15% or 20%, to the average person, 15 or 20%. I mean, that sounds aggressive, right?
Yep.
It's an expensive cost of capital, and we're not here to argue that. But when you compare that to typical margins in business, right? Like, when you're selling a product, typical margins in business are probably somewhere between 25 and 40%. I mean, heck,
Depends on the industry.
coffee's hundreds of percent, right? So, but when you look at the business and you say, hey, we're moving inventory, we're making 25, 30% a week on our inventory, we need capital in the business. Do we give up some equity where as this company grows over time, what is that costing you in the long run? Or do we take, some bridge funding and, maybe pay 15, 20%, but, if we're making, 20% a week, it's 80% a month, we're still far in the green on the investment, and this lender is there when you need them and gone when you don't, right? So once that loan is paid back, the lender's out of your hair and you've retained all equity in your business. So we've been seeing that a lot. We've actually seen, and I don't want to get too deep into this rabbit hole, but there's been some businesses, publicly traded companies that were maybe doing like PIPE funding.
Yep.
And giving up stock in the business and taking funding at, I don't know, what is it, like 15, 20% for?
Sometimes higher.
Right, sometimes higher. And then afterward, you're selling shares of the company at a discounted rate. Where some of these companies have paused what they were looking to do with the PIPE funding and have actually, kind of pivoted over to the alternative lending.
Yep.
When they learned, like, wow, hold on, I can get a junior facility, I can get $5 million on, a 12-month term, 24-month term, 36-month term with a monthly payment, and the lender is able to structure a payment that fluctuates with my need and what's going on in my business. So, we've seen that a lot recently. And again, it's just, when you're aware of, what products are out there and how they operate. And what we really want to drive home today is the flexibility, right? Like the ease of use. Like we haven't really hit on that so much, but like the ease of use, to apply with us, for a loan, Greg. If somebody comes in and they're looking for $1.5 million, tell us that process.
Very simple and easy. You'll get on the phone with myself or one of our trusted team members here and our consultants, understand your business, your need, but when it comes down to paperwork, realistically, a one-page application, six most recent months of business bank statements, your last year's tax return, and a year-to-date P&L and balance sheet. Does not need to be audited by your CPA firm, but it can be an internal QuickBooks copy. And that's all we need to get everything started. Come back to you with some terms, some numbers, and take it from there. Yeah,
and as far as like documentation needed, what do we say? A couple months.
6 months of bank statements, year-to-date P&L and balance sheet, and previous year's tax return.
Gotcha. Yep. So very short list of documents needed. How long? Once a business owner submits you the bank statements, the financials. how long until you're typically receiving an approval on that business, and what does that process look like?
Great question. So it's very, very straightforward, quick and easy, right? We'll submit everything once we receive the documentation, and usually 1 to 2 days, we'll have some concrete terms and approvals and go over those options with you. If you're ready to move forward, we move as fast as our customers and our clients do, right? So if you're ready to move forward, we could, for closing documents, typically just the funding agreement, maybe a driver's license, a voided check, a few other documents that you should have within arm's length, and they can wrap that up very quickly.
Yep. So one thing I love that Greg has established over the years, working with one of our better lending partners, when we do funding, over call it 750,000, we tend to have a few partners that we really feel most comfortable with, that we've really have built out a great relationship. And Greg has worked on a process with them that we find has really helped small business owners connect with the lender, keep the process running smoothly, and ultimately, because of the process he put together that I'm about to go into, really allows the lender to really ask questions, understand the business from the inside out, which really helps strengthen the approval that they ultimately put on the table.
Absolutely.
Because that approval is now loaded with information of what they're using the money for, what the past, the history of the business has been, challenges they faced, and now they can really customize an offer really specific to that business and their needs. And basically what that process is once you submit the bank statements and the financials, and now we're not like the traditional bank. We're not going to ask for multiple year tax returns, and we're not going through this stuff with a fine comb and beating you up on every little thing that's there. It's honestly extremely casual. It's 3 to 6 months of business bank statements. It's a year to date or the most recent quarter even of profit and loss and a balance sheet. If you're a business that has like ongoing work, they may request like a WIP report or something like that, just to know kind of what you have going on in progress. But once you submit this information to us, Greg and his team are going to share this with the lending partner, and we're going to have an offer back, usually within an hour, right? They're going to come back and they're going to give you an offer. It's going to be a dollar amount, a term, a rough cost of capital. But really what's going to happen at the time that offer comes over, they're also going to provide a time for an interview, which this is what Greg had put together with our lending partner. He just kind of felt like, there's, in these businesses, there's so much going on outside of what you can see on the paper, So with that being said, Greg had requested that we start to schedule like an interview between the lender, the underwriters, and the business owner. So the business owner has an opportunity to kind of explain the story and give some color to the numbers on the paper. And so when that first approval comes over within an hour, it comes over with a scheduled Zoom time where the business owner, ourselves, the lender, the underwriters at the lender can get on a call and just have a casual conversation. Just, hey, this is what's going on. This is what we're looking to accomplish. The lender already has the financials. They already have the bank statements, so they're able to ask specific questions about things that they see within the financials. Gives the borrower an opportunity to explain some of that. I'm sure there's a lot of us, but by a show of hands out there, like how many people have applied for some type of loan at their bank or whatever the case may be, and you're just like watering at the mouth to be able to talk to the underwriter yourself, right? Like, hey, listen, like I want to send this over. Like I know my credit score is showing as a 720, but I'm trying to explain something that took place on there that when you just look at it, you're going to assume that the score is what it is for a reason, but there's actually like a legitimate thing that took place. And you feel in your heart, like if you had the opportunity to speak to somebody, you could make sense of it, and it would help everybody involved, right? Because the bank, I think they want to get deals done. I know that we do.
Yeah, we see that all the time. It gives the business owner or their team of professionals, their CFO, their CRO, the opportunity to explain what happens on paper and understand the next 30 days, the next 6 months, the next year after that capital is put to use, right? And after that, A lot of times, terms can get longer, dollar amounts increase, the flexibility really comes through.
Yeah.
So that's your opportunity there to really
Yep.
connect the dots and fill that picture with color.
Absolutely. So yeah, so that's what I love about that process, is when Greg implemented that like interview process, or that conversation rather, where the business owner actually gets the opportunity now to get on the phone and speak directly to the underwriter. It's something super unique. It's something that I've never seen in traditional banks. I don't really believe there's anybody else in our industry doing anything like that. That came from doing a lot of business with this particular lender, getting very familiar with one another, building a personal relationship to the point where there's a lot of trust that exists between that lender, us as the broker, and them listening to us and us, saying like, hey, like we feel like this can make a major difference. And it really does. Not only does it give the borrower an opportunity to explain some different things and really provide color around what's happening in the transaction, but it also keeps the process really rolling and keeps everything smooth, right? When we get off that call, everyone has a much better understanding of what's going on in the picture. From there, they harden up the offer. They like you said, they might increase the dollar amount. A lot of times, we see the dollar amount get increased. We see the term get increased. The cost get dropped. But the biggest thing that we see, this is where the customization happens. This is where the lender says, okay, now that we really understand what's going on here, why don't we do this? Why don't we do a discounted payment for the first X amount of months? Then we'll increase the payment to here. We'll set up a refi. A lot of times too, we see add-ons be brought into the picture where it's like, all right, hey, we're going to do 1.5 million now, but when you complete phase one of that project, we're going to release another 700,000 in a month.
Right.
So this is the type of flexibility that we really wanted to bring across and make known to the mid-market businesses is that, you have a Swiss Army knife here in the alternative lending space. These products can really be beneficial if you work with the right partner that brings you to the right lenders and ultimately helps you navigate and helps you push the limits, right? Like these offers are far from cookie cutter, but they easily can be, right? If you're working with the wrong broker or the wrong partner and they don't know that you're allowed to customize and push the lenders and, express to the lender what's really needed to make the deal work, they're just going to get the first offer that comes out. They're going to present you with that, and that's what you're going to be stuck with.
Yep.
But when you have a partner like ROK that's been doing this for a long time and is one of the largest marketplaces in the entire country and has close relations with the lending partners and understands what their abilities are and how flexible they can be, we can bring that to your transaction, and ultimately you're the one that benefits from that. So
it all comes back to the passion, the education, the understanding of what moves in business, and being your advocate to the lender, right? And really pushing on those buttons to throttle up the offer and customize it for what's going to make the most sense for your opportunity, your challenge, and the next 12 months, 24 months, 36 months, and beyond.
that's a great way to put it, is the advocate for your business. We're here to fight on your behalf to get you the best offer possible. And one of the ways that we kind of carved out to make sure that happens is by giving you your moment, giving you your opportunity to speak directly to the lender and be able to talk on your business. But you do need to be able to talk about your business. We've had some people get on these calls and they don't understand the numbers and the ins and outs of their business, and that's a major challenge, right? So we definitely want to make sure, and that's something we'll prepare you for as well.
Absolutely.
Before we schedule for one of those interviews, is just making sure that you understand the numbers, because when you can speak sophisticated about your business, it really raises like the level of like trust and confidence,
The comfortability.
that the lender has in investing into your business, because that's all they're doing, right? Like they're listening to you, they're looking at the financials, and ultimately they're making a decision on if your business is going to be one that's worthy of taking this funding, growing your business, and ultimately paying them back, right?
That's right.
And if they're wrong about that, that's obviously a major issue for all. So some other things that we wanted to talk about is just matching financing to your business goals, right? Like if you have a goal of short-term cash flow or an equipment purchase or an expansion purchase, you're looking for more inventory, or you have a large growth initiative, the possible financing strategies that support that goal, right? And I think this really, just goes into really explaining that, we're not just a one-trick pony. We don't just have, short-term working capital, but we have an array of products here. We do equipment financing. So a lot of times we'll see people using cash, cash flow from the business to purchase a new piece of equipment, and we couldn't disagree with that more. Cash is king. You definitely want to keep the cash flow available in the business, especially if you have the ability to finance the equipment.
That's right.
And equipment financing is it's a very old school product. It's been around for many, many years, far longer than the alternative lending space. And because of that, the terms on working capital are considered to be a traditional product. You're looking at a typical APR. You're looking at multi-year terms, 5-year, 7-year, could be 2 to 3 year. And traditional monthly payments. So if you have the ability, you need, some yellow iron in the business, instead of going out and dropping, 150, 400,000, could be $1 million on a piece of equipment, looking into equipment financing and seeing if you could, structure that out over a multi-year term, with a traditional, low APR, and take advantage of that. That's obviously going to be a much better option than
Absolutely.
Utilizing the actual cash in the business.
I mean, you said it best. Preserve that cash in the business for actual cash purposes, right? And if you can finance that asset because you're adding an asset to the business over that 3-year, 5-year, 7-year term,
Yep.
preserve that cash and finance that out over a number of years.
Yep.
Not to mention the tax benefits that come with a lease or finance.
Yeah. No. Absolutely. Another product that I feel like has become a favorite of mine that I feel like not enough people take advantage of, and we talked about it earlier, was the invoice factoring. The factoring product is another one that's been around for a super long time. Traditional monthly payments, traditional APR, very low cost of capital. You basically get a portal that you could upload the invoices to that you're looking to factor and basically draw a line of credit against those invoices. Yep. What is it, typically 80% of what's owed out to you within like 90 days?
Yeah, about 80%.
About 80% of what's owed to you. Over the next 90 days. So basically, if you have any invoices that are due to be paid within 90 days, let's just say it's $100,000, you'd be able to get a line of credit of $80,000. And I'm just using $100,000, but it could be, millions of dollars. If it's $1 million that's owed out to you in the next 90 days, 80%, $800,000 that you could access right away today and not have to wait for those invoices to be paid.
And it's a lot of time pick and choose, right? It's your borrowing base that your invoices, the money that's due to you over the next 90 days. That's can be a large borrowing base, and it's a no payment line.
Yep, absolutely. So, I think a lot of people, that I've come across in the past that maybe had any type of an issue with like a factoring line is, they don't want their customers to be notified about it.
That's the biggest hot button.
Yeah. Everyone seems to have an issue with that, but I'm happy, that I'm able to respond to that with, well, we have a non-notification product.
That's right.
We work with lending partners that do not notify your customer base that you're factoring or that, they now need to pay this third party instead of paying you. How they do that is really they just create like an escrow account that both you and the lender share. You would just basically update your customer base that you've changed bank accounts. Hey, you used to pay me to account A, now you pay me to account B. They're still paying you in their eyes. They have no idea that you're factoring. And I do just want to stop and say that, like, if you really understand business and lending and financials, factoring in a business is a totally normal thing to do. So I understand that you might not want your customer base notified, but I also do want to sit here and say that, like, it's not the end of the world and it's not a big deal in any capacity. Like, a lot of it's smart for a business to have a factoring line.
Of the unspoken about, right, is a lot of these business owners don't realize that they're getting a built-in collections department by bolting on this product, right? Because at the end of the day, they have just as much as interest as you, the business owner, to get those receivables. So if you don't have a collections department, that's something there that can get those invoices or those payments in quicker, thus reducing the cost and your own little built-in collection department.
Yep. And I don't know many non-credible businesses that have a factoring line, right? So like, if you do have a factoring line and your customers know about it, it's kind of a flex. It's kind of like, hey, we're a good enough business and trustworthy enough business where we have a factoring line. We're sophisticated enough where we understand lending and finance and how to leverage an asset in our business to create a line of credit to continue to grow our company.
Right.
So, I do think personally some people look at that the wrong way, but with that being said, my opinion doesn't matter. So if you don't want your customers notified, that's perfectly fine. We have a product where it's a non-notification. So whether, whatever side of the ball you're on that, either way, we have a solution in place. So, but, just wanted to kind of speak on that a little bit. All right, we have, so we're going to move down another slide. Right here, we're going to go to what business owners should prepare before applying. And Greg and I have kind of touched on this already. But, again, helpful items may include, the recent bank statements. They're typically going to want to see 3 to 6 months of your business bank statements. What are they looking at, right? Let's give some insight. Like when they look at your business bank statement, Greg, what are like some of the, give us 3 or 4. Like what are the key things? They look at your business bank statement. What do they want to see? What do they not want to see?
Great question. So what they want to see in the business bank statements typically are your total monthly revenues, right? That gives them an idea of what your annual gross sales could be. And then also, most importantly, are going to be your ledger balances, right? How much money are we keeping in that bank account? What does the cash flow on the day-to-day look like in that business? What they're not going to want to see is a lot of transfers to and from, right? Or NSFs or overdrafts. And if there are transfers to and from,
NSFs, negative days.
Negative days,
Gotcha.
non-sufficient funds. It's not too commonplace in the mid-market segments, but if they're, what is more common are payroll accounts, right? If we're transferring money over from the main operating account to the payroll account, have those accounts as well, not just where all the money comes in, but if there are other accounts that are transfers to and from for either tax purposes or payroll purposes, to have those bank statements in order as well, so that underwriting can look at and assess all the organic revenue coming into the business.
Yep, absolutely. Revenue documentation, maybe some type of financial again, or like a WIP report, but a lot of times, the bank statements are really going to, satisfy that. Basic business financials, profit, loss, and balance sheet are definitely the big ones, and typically they want to see year to date is usually what's most important. Clear use of funds. Greg, you want to elaborate a little bit on why the use of funds is so important?
It's a great important, right? Because it designates if it's that opportunity or challenge, right? So the use of funds to really assess what product, what lender specifically is going to be the best outcome for the business, whether we're solving that challenge or if we're generating that opportunity for the business.
Yep. Absolutely. Alrighty. And then, understanding repayment goals and timelines. Again, that's like the customization side of this thing. If we understand, what you're looking to use the money for, when you want it to be able to pay it back, how you need the structure of the loan to go, this is all going to help us advocate and, really explain that to the lender so that when we are putting the product together that's going to work for you, your particular funding, that it is fitting your needs and checking all the boxes, and it's actually going to be something that helps the business and doesn't hurt it. So
and understanding those repayment goals and timelines is huge for us, right? As being your advocate, that's going to help us negotiate with the lender. Hey, we might need a 24-month term here to make sure that payment is manageable for the business taking on this opportunity, but also at the same time, really push and advocate for some strong prepayment incentives for businesses to save money, right? So it's not always bringing everything to full term. A lot of times we'll see people want to pay off early and receive a larger discount. So we could talk about that as whenever you're ready and as those opportunities come up.
Yeah, absolutely. All right, cool. And yeah, again, just to kind of, summarize the structuring, the financing the right way, the loan term length, obviously super important, based on, what the use of funds is, payment frequency, speed of funding, right? Getting this capital in your hands as quickly as possible is obviously always our goal. When you're determining, if the funding is right for you, we always, like the formula of, the cost versus the ROI potential, I think a long time ago, somebody once said to me that the cost was irrelevant. And at that time, I was a consultant, right? I was speaking directly to business owners, and I felt the pain around the cost of capital, right? And the complaints and the feedback that would come around the cost of capital. And when somebody said to me the cost is irrelevant, I'm like, man, it doesn't feel irrelevant. When I'm talking to these small business owners, it does not feel irrelevant. But then they broke down the cost versus ROI potential, and they really helped me understand what they meant by the cost is irrelevant. And what they meant by that was kind of the example I was giving earlier, where, if you're, coming to us, and we do this all the time, right? We maintain a 5-star rating on Google and Trustpilot. We have, over, 3,000 reviews on the internet of people that have worked with us. And again, we maintain that 5-star rating. We're very proud of that, obviously. But how we've maintained that reputation is by education, right? And talking to people like they're people. And if somebody comes to us and the use of funds and the cost versus ROI potential doesn't pan out, we're going to be the first person to tell you that this isn't for you, right? Because the last thing that we want to do, one, is invest our time, right? Because time is money. Whether it's your time or our time, they're both important, right? We don't want to waste yours. We don't want to waste ours. And if you're coming to us and you're looking to consolidate credit card debt, I mean, you're going to solve a short-term problem all while creating a longer-term problem. So it's not going to be a good use of funds for us, and we're going to be the first person to tell you, like, hey, that doesn't make any sense. But I remember I had a transportation company I was working with one time, and he was really hung up on the cost of capital, but he was explaining to me that by adding this other truck to his fleet, he was going to add like $300,000 a year in gross revenue to the business off that one truck, And I think at the time, how much he was looking to borrow, I think the payback, what it was costing him to borrow that money was like $35,000. And I'm like, listen, I understand that, the factor rate that we're charging, and that's a whole other thing that, we can get into, but understanding the difference between a factor rate and an APR. An APR is obviously compounding interest. So when you have something that's, 5, 10, 15% APR, as long as that debt is existing, you're constantly accruing that interest charge. When you're working on a factor rate, which is the way that a lot of our products are structured, that's a one-time set cost of capital. It's basically, if you picture that money sitting on a shelf in a store, it's got a price tag on it, right?
It's
so
fixed.
And the term that we give you is really just a targeted term. So if we tell you that you're on an 18-month term, that is basically saying that the way the loan is structured, you should be paid back within 18 months. Now, if normal business happens along the way and it takes you 19, 20, 24 months to pay that loan back, as long as you're in communication with the lender, there's no penalties for that, right? You're not in default. You're not going to be charged additional costs for that capital. So that's kind of the nice thing about a factor rate is going into it, you know exactly what that money is costing you, which allows you to run the formula of cost versus ROI potential, right? So going back to that example, if it was costing him $35,000 to borrow this money, but he was going to go and buy a truck that's going to add $300,000 a year in revenue, okay, so the first year it's 270, 260,000, give or take, right? On what that truck is going to make for your business, but it's still in the green, it's still earning, and now years 2, 3, 4, 5, and so on. This loan no longer exists. You're paid back. There is no cost associated anymore. And now you just have this truck that's generating additional revenue for your business.
Absolutely.
So, when it comes to borrowing like alternative capital and capital in general in your business, like it really should be like an emotionless, activity, right? Like it's not about, getting caught up in too much. It's understanding what does it cost you? What are you doing with it? And if you execute on that plan, what could that mean for your business? And does the risk, outweigh the reward and vice versa? So, that's really how you should be looking at, funding and financing for your businesses. Is it going to put you in a better position? And if so, and it's available and you can get it, and maybe there's products that you know of that are lower cost or would maybe, quote unquote be better, but it's not available to you, then what good is it? Right? It's not there, right? Like, I used to always make the joke, but my wife doesn't appreciate the joke. I used to, we all want things in life, but, you take what you get, It's a joke. But anyway, that's how we look at things, right? If you're, looking for, a bank line of credit, but, the bank is tapped out or it's not available or whatever the case is, and this alternative lending product's over there, and maybe you don't know as much about it and whatever the case may be, at the end of the day, if it's available to you and we can actually get the money in your account and you could use it to grow your business, you should be entertaining it.
Absolutely.
And that's really what the point is there. All right, why does timing matter? Some different things that, if you're kind of on the fence of, hey, should I borrow, should I not borrow? You should secure that inventory before the price increases, right? You should launch that marketing campaign ahead of your competitors doing it first. Expand staffing during growth periods, respond faster to unexpected opportunities, and take advantage of seasonal demand. We always say, timing is everything. In our business, time kills all deals. There's many times where we have a business owner approved for a product and they're hesitant on moving forward, and they decide to not move forward, and then they come back 30, 60 days later, and things have changed in their business.
Yeah,
that's why now they're coming back, right?
Absolutely.
Maybe they were in a little bit better position where they were allowed to be a little picky on what they wanted, so that caused the hesitation. But now they come back 60 days later because things have worsened, and now the offer that we had for them is no longer the offer that we had. So
things change.
Things do change.
That's something that's not talked about enough, right? The best time to apply is when things are going good, right? So if there is some seasonality or maybe some unexpected or expected turmoil in the coming 60, 90, 120 days, you might want to get in front of that and get around that beforehand to get a jump before things could change in the business, therefore ultimately affecting the approvals.
Yep, absolutely. We have one of the last slides here. It talks about partnering with the right financing team. I'm going to take an opportunity here just to be extremely blunt, direct, and real. The negative to our industry, because there is a negative, right? I'm not going to sit here. It's not all bells and whistles. The negative to our business is there's no barrier of entry. Our founder spends a lot of time nowadays. What he focuses on in the business is working with the Small Business Finance Association. This is an organization that is kind of like self-regulated in its sense. It's a group of industry professionals, industry veterans that have come together and understand that if we don't self-regulate and clean up some of the bad practices that are out there, it could ultimately have a major effect on our industry as a whole. And we obviously want to preserve our business. We're solving a major or filling a major void for small businesses, medium-sized businesses that need to access capital that just simply cannot. And the truth of the matter is there's a lot of people today that have now, as the industry is becoming more mainstream, have jumped into our industry, have opened up a broker shop, right, and are facilitating these transactions. But the truth of the matter is they don't know what they're doing. That's Correct. It. That's the reality to the game. Is they might have worked at a company, in a junior role for a few months, and then decided, hey, I'm going to go jump out and do this on my own. And because it's an unregulated business and there's not a large barrier of entry, there's no filtering and keeping anybody out from becoming a broker and marketing to your business and telling you they can help you get funding. And now you don't know better and you apply with them. It's like getting in the car with an underage driver or somebody with a learning permit. Right. How safe are you really going to feel? Like, yeah, they may get you to from point A to point B, right? But is the car intact? Does your neck hurt? Were you ever going to get in that car again? Do you learn things after the fact that you wish you knew beforehand? So, these are a lot of things that is just the reality of the beast here is this is out there. There are many companies that have popped up as overnight brokerages that are marketing as if they've been doing this for a long time. How you would really know who to trust and who not is you got to look at that online reputation, right? If you're being contacted by a company to help you get funding for your business and you look them up and they have no website, or they have that all the cartoon characters as their team members on the site, or there's no Google reviews and no directory. Red flag, that's a big thing nowadays. Is everybody talking about the red flag, right? Well, there's your red flag. If you look up ROK Financial, you have all the confidence in the world. Our address is plastered right on our website. We let you know where our headquarters is. A lot of these companies will not give you their address, our phone number, our entire team, our real faces, our real names are plastered on our website. We have thousands of reviews online. We have a genuine, authentic, established online presence. And we're very proud of that, right? We've been doing this for a long time. We're highly educated on these products. We have the best relationships with the top lenders in the industry that don't work with just anybody. So if you're working with some brand new broker that just jumped into the business and is posing, right? They're posing as somebody that has been doing this for a long time. You're going to learn that broker doesn't have access to all the lenders that are out there, because the top lenders that have the most favorable terms and the highest dollar amounts and the most amount of flexibility, they're not working with those newer brokers. So you're not going to see the type of offers, the 7-figure deals, the interviews with the lender, being able to speak to an underwriter. This is not for everybody. We've put the work in, right? We've been doing this for quite some time, and we've established ourselves as a real brand, as a household name in this industry. So you really want to pay attention to who you're talking to. There's a lot of business consultants out there nowadays, right? You can go on LinkedIn, upload your photo, call yourself a business consultant, and now you're reaching out to CFOs, telling people you can help them get funding, and then they just bring you to one of these brand new startup brokerages, and before you know it, your information, your data is being sold all over town. Your phone's ringing 75 times a day with overseas people trying to sell you loans, or AI trying to get information from you.
Who knows what else?
It's a disaster. It's
I
a
was just
disaster.
going to touch on the data portion of that, so
Yeah.
definitely be careful.
Yeah, you have to be careful. It's an absolute disaster. And again, it's why our founder spends his time nowadays trying to remove these type of people from our industry. We want there to be regulation. We want there to be licensing requirements. We go about this business the right way. We do not take any shortcuts. We are built for the long term. We welcome regulation. We welcome licensing and any other type of bonds or anything that could be helpful to removing the posers and the people that claim that they can help your business. How many horror stories, Greg? I mean, we get people that will come to us and say, hey, I took this loan from this broker. He told me if I take 2 loans at once, then I'm going to be building twice the relationship with the business credit, the payment history, because I'm taking 2 loans. Taking 2 loans is called stacking. You're not allowed to do that at the same time. It will bar you from this industry. It will prevent you from ever getting funded again. Anybody who ever tells you take 2 loans at once of the same type of loan is absolutely not giving you the right information. And if anybody's promising you, hey, if you take this product now, I can get you an SBA loan in the future, that's not how the SBA works. In fact, there's a lot of times where SBA doesn't want you to have other types of funding out, especially alternative lending at times. So, again, it's misinformation, it's fake news, it's people trying to tell you things to coerce you into working with them. They're looking out for themselves. They're not looking out for you. They have a short-term mentality on their business, and they're not going to be around for a long time. So, partnering with the right financing team, it really does matter. And why? Because it's going to help you understand what's out there. It's going to structure the financing with a strategy behind it. It's going to help you navigate a changing market and the market conditions, aligning your capital with the growth goals, and ultimately save you a lot of time and aggravation, during this funding process. So that's a lot of what we had for you guys today. The last slide just kind of talks to you a little bit about ROK. If you want to take your time and read that on your own. Also, do your homework, look us up, read the reviews. There's a ton of content on the internet about us. So, we're not hiding. We're right out in the open. We're here to help small and medium-sized businesses. And again, the biggest thing with this is the demand that we have seen. I mean, the average loan amount has increased tremendously. I mean, there was a time when we were in the business where if you got $100,000 or $150,000 offer, that was like taboo. It just didn't happen. Then the new 150 to 250 became 500. All of a sudden, we're doing loans up to 500,000. Then there was a good, 2016 to 2019, we would get $1 million approvals, but they never closed. If one of my consultants came to me on the floor and said, hey, I just got this $1 million approval, can you help me kind of strategize on this? I hated it. I didn't like that they got $1 million approval because the consultant was going to focus on that transaction over all other transactions, and the likelihood of that deal actually hitting the finish line was slim to none. And I'm not a negative person, but I am a realistic person, and at that time, those deals were just not funding. And then, I would say probably 2022, 23, all of a sudden, like wildfire, we're dropping $1 million, $1.5 million, $2 million, $3.5 million deals. Every single week, we do a seven-figure deal now. Every week, right? Months, we're doing a few of them. We're doing, I don't know, 5 a month of seven-figure deals.
At least that.
Between 5 and 10 a month, seven-figure deals. I would say we probably average like 6 or 7 seven-figure deals a month.
Yeah. Just yesterday, 900,000 AR facility, 2.8 million AR facility last week.
So we're doing a lot of these larger transactions, and again, the timeline is legit, right? There was a period of time where 250 was a big deal, then it was 500, then we were seeing the $1 million offers, but they weren't getting done, and now we're seeing the offers and they're getting done. We've have shifted our focus as a business towards these seven-figure transactions. Honestly, anything under 500,000, we do it, right? Because we're here to serve a small business and we'll get the deals done. But where our focus and where we're training our sales team today and our consultants is how to service the seven-figure deals, because that's what we're seeing a lot of right now. And that's ultimately becoming the future of our business right now. Is there's going to be brokers that do, 20K to 150K deals. There's going to be brokers that do 150 to 500, and there's going to be brokers that specialize in 500 and above, and that's just the direction of the industry right now. We're seeing a lot of demand coming upstream to downstream, right? Like, again, there was a period of time where mid-market businesses were not entertaining us. They were not. We didn't waste our time marketing to them. If we did get into contact with them, it was usually a waste of our time. We would look at the deal, present them with something, it would never work. And today, it's completely different. And I think just important things for mid-market businesses to know is we can subordinate to senior facilities. We can subordinate to factoring lines. Our loans are fully unsecured, right? There is no real collateral. There's no liens on the business, homes, equipment. The only collateral is future revenue, right?
Correct.
As long as you're in business and you're generating revenue, you owe that loan back, right? But outside of that, there is no hard asset being leveraged in any way for this type of funding, even the seven-figure deals. And there's a lot of times where we're able to fund with no UCC, which has been huge for us, right? A lot of times businesses don't want a UCC filed on the business. What do they call it? The good guy clause or the bad guy clause?
The bad boy clause.
It's the bad boy clause, right? So they won't file the UCC until you start missing payments.
Correct.
So you'll take the funding, could be a $2 million deal, no UCC, no collateral. If you start making or missing payments, rather, then they could have the right to go ahead and file the UCC, which obviously I think we could all agree at that time is the right time to file the UCC. But otherwise, if there's a reason, you're working on something else in the business and you can't have a UCC on the business, that's part of the customization process. That's something that we can work out for you and get you the funding that you need with no real collateral, no UCC filed, and again, custom payments, repayment structures, high dollar amounts. Nothing's off the table, right? So we appreciate you taking the time to kind of sit here with us as we went through this and learn from the things that we're sharing here today. Both Greg and myself are highly accessible, so feel free to connect with us on LinkedIn, social media, send us an email. Greg at ROK.biz, Patrick at ROK.biz. Always open to a conversation and a strategy call to figure out how we could help you or your business or overcome something that's in the way. But again, take a lot of appreciation to you guys for watching this, and any way that we can help, please let us know.